The stock market just reached new all-time highs once again. Not only the S&P 500 index in the US, but also globally when looking at the FTSE All World. So if you're only starting to invest now, or you've been sitting in cash waiting for a better opportunity, buying stocks or ETFs today probably feels slightly uncomfortable. Because surely investing after markets have already risen this far must be one of the worst possible times to start, especially when so many investors believe anything connected to artificial intelligence is overvalued, that today's market looks increasingly like the dot-com bubble, and that a major correction or even a crash is only a matter of time. But there's also another possibility that receives much less attention. Waiting for the market to get cheaper could turn out to be a big mistake as well. So in this video, let's investigate what happened historically when investors bought at previous all-time highs, whether today's market really has become dangerously overvalued, and what the earnings we're currently seeing might tell us about how much of this rally is actually justified. If you're new here, my name is Angelo, and I've been investing in low-cost ETFs for over 9 years together with my wife. So why does buying at a record high feel like such a bad idea? When the market reaches an all-time high, anyone investing today is paying a higher price than investors did at any previous point in time. But what does an all-time high actually tell us? Only that the price of an index is higher than it has ever been before. It doesn't tell us how expensive the companies in that index are relative to their earnings. And it certainly doesn't tell us what happens next. In fact, if we expect the stock market to grow over several decades as it has in the past, it has to keep reaching new all-time highs along the way. And as we can see here, these record highs haven't been rare isolated events. They've occurred repeatedly and often in clusters as the market has risen over time. Of course, any one of those highs could be followed by a major correction, but it could also be followed by another all-time high and then another one after that. This is what makes waiting for a better entry point so difficult. A 10% correction might sound like a great buying opportunity, but if the market first rises by 20% before falling by 10%, that supposedly great opportunity still leaves you buying in at a higher price. So for long-term investors, the important question isn't whether markets can fall from all-time highs. Of course they can. The more important question is whether reaching an all-time high has historically been a reliable signal that waiting is likely to pay off. And this is where the data becomes quite interesting. So what actually happened when investors bought at previous all-time highs? One analysis by Fidelity looked at S&P 500 returns going back to 1950. During the 12 months following an all-time high, the index delivered an average total return of 12.7%. And during all other 12-month periods, the average total return was 12.6%. So historically, the difference was only 0.1%, which might be surprising because you might expect investing at the highest price ever recorded to produce significantly worse results. But at least based on this data, that simply wasn't the case on average. And this isn't just an American pattern. Looking at the MSCI World Index from 1970 to 2025, Dimensional found something similar with an interesting twist. Investors who bought after the market had dropped over 10% were doing better on average 1 year later than those who bought at all-time highs, which makes intuitive sense since sharp declines have often been followed by sharp recoveries. But over 3 and 5 years, the opposite was true. Investors buying at record highs were, on average, better off than those who bought after a drop of over 10%. Of course, past performance is not a reliable guide to future results, but this data shows that an all-time high on its own has historically not been a reliable warning that you're better off waiting as an investor. By the way, you can find my favorite low-cost brokers for ETFs in Europe linked down below, which is a great way to support me if you'd like to. Okay, but what if this is another dot-com bubble? At first glance, the comparison isn't completely unreasonable. Many investors are optimistic about a new technology, this time AI, that could transform the economy. Companies are spending enormous amounts of money trying to benefit from it, and some of the world's largest stocks are valued based on high expectations for future growth. But there's also an important difference. As economist Ed Yardeni puts it, the dot-com bubble was largely driven by FOMO, the fear of missing out. By contrast, this rally seems to be increasingly driven by FEMO, or fabulous earnings momentum, meaning there's much more growth in the underlying businesses supporting the rising prices. And we can see part of the difference by looking at valuations. During the late 1990s, investors became willing to pay dramatically more for every dollar of expected earnings. Before the tech bubble peaked in March 2000, the sector's forward price-to-earnings ratio had increased by almost 250%. Yet in the current bull market, which began in October 2022, it increased by only 18%. So while technology stocks are certainly not cheap today, their valuations haven't expanded by anything close to what we saw during the dot-com bubble. And today's rally has also been supported by strong growth in the underlying businesses. According to the latest figures from FactSet, revenues across the S&P 500 grew by 15% compared with 1 year earlier, the strongest growth since 2021. And this wasn't limited to a handful of large technology companies. All 11 sectors of the S&P 500 reported higher revenues than 1 year earlier. So while AI enthusiasm has clearly played an important role in this rally, the idea that the entire market is driven purely by speculation seems a bit far-fetched. Many of today's largest tech companies already generate enormous revenue, profit, and cash flow, something that wasn't the case with many popular companies during the dot-com bubble. Having said that, let's examine what could still go wrong. The biggest question may be whether the enormous amounts currently being spent on AI will actually translate into significantly higher earnings in the future. That's something we simply don't know yet. After all, stock prices don't just reflect how much companies are earning today. They also reflect what investors expect them to earn several years from now. And when those expectations are already high, share prices can fall even when companies aren't necessarily performing badly. Their earnings might continue growing, but if they grow less than investors expected, that alone could be enough to disappoint the market. So if AI investments take longer to produce returns or ultimately generate less profit than expected, we could see the stock market move lower. None of this means that a correction is about to happen. It simply means that even investing in strong businesses carries plenty of risk when a lot of future success is already reflected in current share prices. Now, there's one final historical pattern worth examining, because 2026 is also a US midterm election year. Historically, these years have produced below average returns and more volatility in the stock markets, particularly in the months leading up to the election. But during the fourth quarter, which begins around 1 month before election day, the S&P 500's median quarterly returns have historically been quite strong, and the index ended the quarter with a positive return between 80 to 83% of the time. Of course, this pattern doesn't tell us what will happen this time, as past performance is not a reliable guide to future results. It is still based on a relatively small number of presidential cycles, and the economy and stock market face completely different conditions during each one. But it does provide another reason why waiting for a correction, simply because the market is currently at a record high, could easily backfire. So, what does all of this actually mean for long-term investors? If you're already investing a fixed amount every month, I don't think current market prices are a reason to change your approach. None of this data is a reason to speed up, slow down, or try to time your next contribution. It's just a reminder that record highs on their own have historically not been a reliable reason to pause, as they occur quite regularly. And if you're sitting on a larger amount of cash, it's worth separating two different questions. Money you may need in the next few years for a house deposit, your emergency fund, or any other near-term expense faces a very different level of risk if it's exposed to stock market volatility. But money that has been set aside specifically for long-term investing is a different question. Historically, investing it all at once has on average outperformed investing it gradually, simply because global markets have risen more often than they have fallen. But if putting a large sum in all at once feels genuinely uncomfortable, spreading it out over several months can be a reasonable compromise. It may reduce your potential return if the market continues rising, but it may provide you with extra peace of mind. Either way, a plan you can realistically follow long term may be more useful than a theoretically optimal plan you abandon halfway through. Personally, my wife and I will continue following our existing long-term strategy, investing in a single global ETF every month, no matter whether markets happen to be rising or falling. That consistency has served us quite well for the past 9+ years. So, is it too late to invest in ETFs? Based on everything we discussed, the market simply reaching another record high is not enough to come to that conclusion. Of course, it could drop next week, valuations are already high, and some of today's high expectations for future earnings coming from AI may never be met. But uncertainty has always been part of investing, and staying invested during this period certainly hasn't felt easy. Since 2020 alone, according to Ben Carson, investors had to endure a global pandemic, the fastest stock market decline of more than 30% in history, Russia invading Ukraine, inflation reaching 40-year highs, rapidly rising interest rates, the 2022 bear market, Liberation Day tariffs, the Iran war, recession predictions every year, and one of my personal favorites, countless crash predictions and top calls by Robert Kiyosaki and Michael Burry. Waiting until all those risks disappeared would have meant waiting indefinitely, because there will always be something else to worry about next. Risk and volatility is the price of admission in the stock market. Nobody knows whether the current all-time high will be followed by another one or by the next major correction. But if you're investing for the long run, constantly trying to predict which one comes next is unlikely to be a good use of your time. That's why I choose not to and instead continue sticking to my strategy. As usual, you can find my favorite low-cost brokers for ETFs in Europe linked down below, which is a great way to support me if you'd like to. And please don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. Nothing I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day and until next time.